I figure we better let people in the door. Oh, and look at that, we're recording here too. Very good. Welcome, everybody. My name's Karen Simmons, the Chester County Community Foundation, and we are having an investment forum on a day that it didn't snow for the first time in 2 decades, I believe. So, usually snows first thing in the morning, and then we have the investment forum by noon once people can shovel and get through. So here's our agenda for the next hour or so. Our board chair, Winnie Moran Sebastian, is going to give a brief update. Our investment committee chair, Mark McCarron, is going to go over our overall goals and models. Our CIO firm, Hurdle Callahan, with Chris Valerio, you can wave Chris, and Nick Fazzi. We're going to do an update on the Community Foundation's portfolio. And then we're going to zoom into some Q&A with all of our investment partners at Hurdle Callahan, Phoenixville Federal, S&T, Merrill Lynch, and Truist. If you have individual questions for people, we'll ask you to stay on after the call, and we're going to talk about the Community Foundation's overall investments. And if you have dogs and traffic and crying babies behind you, my staff will mute you. So if you don't want to be muted, sorry about that. So, and we are doing a closed caption and a recording here because we've had some people who want to make sure that they can hear what we're talking about today. We will send the PowerPoint to you immediately after this session with a link to the recording. How's that? Sound right? The Millers are here. We can go now. Yes. Hi, Marge. Hi, Art. All right. The Millers have been at every investment forum and have started one of our early funds there. So welcome, Millers. I'm glad you're here.
Thank you.
All right. So for the investment forum today at the Community Foundation, Winnie, you want to give it a go?
Yes.
Our esteemed board chair, Winifred Moran Sebastian Esquire.
Thank you. Good afternoon, everybody. As Karen says, I'm Winnie Sebastian, chair of the board, and I'm welcoming you to our investment forum. The foundation is entrusted now with over $100 million in community assets. They are included in over 425 funds established with us by charitably minded folks with a specific purpose in mind. We manage those via our staff, our investment committee volunteers, Hurdle Callahan, and in some cases, independent investment counselors selected by those with funds with us. Today, you're going to hear from Mark McCarron, who's chairman of the Chester County Community Foundation Investment Committee, as well as Chris Valero, who is an investment officer with Hurdle Callahan. The Community Foundation has established a strategic plan to pursue our mission of ensuring that philanthropy makes a difference now and forever. As you can see from the handout, we have broken down that plan into goal areas to grow community needs, funds for community needs, for the nonprofit community, for our institutional sustainability, and for the fund advisors and donor services that we provide. Each year, we give away $6 million in annual grants. Our focus is long-term. This is what the Community Foundation does, and we present this investment forum in furtherance of those goals. Now I'm going to turn it over to Karen for more specific information about today.
Thanks, Winnie. So as Winnie said, we have over 110 million entrusted in charitable assets via 425 charitable funds. That's our core of what we do with the Community Foundation, long-term legacy philanthropy. We have other programs that feed into this. And so people know us through the different doors they come in. Some people immediately start legacy funds with their families or their nonprofits endowment. Some also make planned giving commitments long-term when you don't need that funding anymore. We work, as you know, with individuals or with families who have funds here to help understand what the family's charitable aims are and then to help connect them with nonprofits that they care about over time. We also get people involved on our grant panels, which many have been done virtually now since COVID, and it seems to work out pretty well for people. So it is grant panel season, so Stephanie Stevens will be reaching out for people to serve on grant panels. And for organizations that have nonprofits endowments with us, we like to reach out and help other people know that you have nonprofit endowments and help work with you and your board and your key staff to get the word out about growing those nonprofit endowments through plan giving. We do the detail work so that you can focus on your programmatic work. If you have a nonprofit endowment with us and you're interested in gearing up on plan giving, please let Jason or Stephanie or me know, because that's what we do every single day. There are many people from our Idea Council here. We really have an initiative that's taken off beautifully to include people from different walks of life in philanthropy long-term. So, and to immerse ourselves throughout Chester County in all kinds of programs and services to raise the bar on legacy philanthropy for people from all walks of life. A lot of people know us through our community conversations, which we started almost 5 years ago. And those social justice community conversations take place on the second Tuesday of every month at noon. We'd like to zoom in, and we actually had 75 people this past week for our community conversation. So it keeps growing. We also have Culture Builds Community as part of our program because Chester County is home to so many culture, arts, and heritage resources. We are the convening and coordinating organization for Chester County 250, which will be a celebration and a commemoration of the founding of our country, as well as our unfinished business and journey toward freedom. That takes place in the year 2026, because that's 250 years after the Declaration of Independence was signed. So it's a Culture Builds Community legacy project that we're helping to organize. And some of you also knew us through our Get On Board program. We actually started Get On Board because many of the families who had fund with us were concerned with always seeing the same people on boards and not diversifying to get younger people on boards. Concerned with the long-term strength of the charitable sector, our Get On Board initiative now has about 75 people throughout Chester County who are working with many coaches to help get them ready for committee service and then longer term for board service. And they meet every other Monday on Zoom for board topics as well as individually with coaches. So all of this is to feed the philanthropic strength of the charitable sector throughout the county. And that helps our core legacy philanthropy programs grow. Now, you know about our core legacy philanthropy programs because you are the people who tell us, advise us, as the IRS likes to say, your fund advisors on where your grants and scholarships go. So you can see that through all fields of interest to you, you can make grants to any 501c3 charity in the United States. We help do the due diligence to make sure they're legitimate charities. And we also help you to decide which charities are the best charities for your dollars. Some people of you give for heartfelt reasons, some people give for logical reasons, some for both. And so whether it's heart, logic, or a combination, we help you and your families make great grants now and forever throughout the whole country, but especially in our backyard. What's happening in Chester County is pretty darn important to all of us because we live here, we grow up here, we raise families here, and we work here. So we pay attention to what's in our backyard, but your grants can go to any place in the United States as well, and they do. We have 428 funds as of a few days ago. I think that number's up again. So thank you to everyone who creates funds at the Community Foundation. Some people ask us to make grant decisions. This is where the grant panels come from. Many of you have donor advised funds that you created back years ago or just a few days ago. So there's a good variety throughout the county of donor advised funds. Some people care about maybe causes of fields of interest or geographic areas. So those are field of interest funds. We do some short-term work, very little though. We're basically a legacy group. So that's why there's only a couple of short-term fiscal agencies. And again, there's about 80 nonprofits who we'd like to help with their planned giving so that you can focus on your program work and we can help you focus a little bit on your planned giving work, because that's a long-term six-figure payoff so many times because of the generosity of so many people throughout the region. And Kevin Bath on our staff also oversees, oh my goodness, is it 70 scholarship funds now? So we like to give a hand up, not a handout, to scholars. Education is the pathway to success. So you can see we have a huge family of over 400 affiliated funds under our umbrella. And we have to be extremely careful with the money that you contribute to your funds and make sure it's invested for the long haul. And that's why we're here today. We also want to thank people who have joined our Ben Franklin Legacy Society. Many of you are on the call right now. And you've made the decision that when you don't need your money anymore, so you want some of the funding to go to your charitable funds at the Community Foundation. And we thank you for that now and forever. And that group continues to grow. So where there's a will, there's a way. It's pretty darn easy. So thank you very much for that. Now, because you have funds at the Community Foundation, I wanted to make sure that Bob Ferguson, our EVP of Business Affairs, got to tell you about a new portal that we have been working or aiming for years. And we did a successful database conversion over the past year with Bob Ferguson and Beth Kralis at the helm of our data conversion. And Bob, tell everybody what they're dying to know about their portal now.
Thanks, Karen. So as Karen said, and many of you already know, over the past 18 months or so, the foundation has undertaken a pretty large project to transition our core operating software to a product called Community Suite by Foundant Technologies. And this upgrade has really provided meaningful improvements in efficiency, ease of access to information for our staff. But really a key benefit of this system is the access that we're going to be able to provide to our fund advisors via a secure web portal. At this point, all of our advisors should have received emails in the past 10 or so days inviting you all to establish a login password. And we've seen that actually several of you have already done that. So we're glad to see that we've had some early adopters. This portal will really allow all of our advisors to review both summary and detailed information related to their fund, as well as get copies of fund documents and any financial statements related to the funds themselves. Additionally, both donations to the funds and new grant distributions can be recommended directly from this web portal, which will integrate directly with our system. So we are providing 2 Zoom sessions to walk through the portal in the upcoming weeks for anyone interested in learning how to use it. And you can see the details in the slide here, the dates and times. So please join us at one or both of these. Or if you aren't available to make these sessions and would like some additional details, please reach out to any of us and we can arrange for a time to work with you individually to get you up to speed on how to use the portal. And the last thing I will say was that this portal will probably be used by a good portion of our advisors. We realize that it's not for everyone. And this system is not replacing the access to our staff that you've always had and will continue to have for questions or for information that we can pull together for you. But hopefully this system will allow for more immediate access to some of the details and control over the grant making process on the part of our advisors who choose to use it really to whatever degree they desire. So please reach out to us with questions, comments, concerns. We look forward to seeing you on these Zoom sessions in a couple of weeks to give you more information.
Thank you, Bob. And thank you, Beth Kay, for all your hard work getting that portal up and running. And we did send out some test links to some of you. So thank you for those of you who are on the call who made it through and helped the portal get even better. And now I get to figure out how to use my portal from home too, so I can check my fund balances from home. So I'm the true test of that, I believe. So it's time. Thank you. At this point, how about Mark McCarran, who has chaired our investment committee for 2-3 years now, Mark?
Well, yeah.
Yeah, Mark, can you tell people what you do in your other job when you're not volunteer for the Community Foundation, and then talk about the investment
Absolutely. Yeah, thanks, Karen. My name is Mark McCarran, and as Karen mentioned, I'm the chair of the investment committee for the foundation. My day job, I'm a chief investment officer at a wealth management firm here in Philadelphia called Westcott Financial. So I get to do this for my day job and my volunteer opportunity and my commitment to the foundation. And as chair of the investment committee, I'm one of about 10 investment professionals who really, they all have day jobs as well, sort of in the world of investment management. So we're a good group. We oversee the investments of your dollars, and ultimately our role is to oversee the investment implementation and report back to the board on guidance, advice, and recommendations as to what we think should occur. And that could include what is the investment policy that we should be following to invest these dollars. And that includes within it, what's the right balance of asset classes, of stocks and bonds and cash and others, to ensure that we're able to grow the portfolio as a committee and partnering, we'll get into this, partnering with our outsourced chief investment officer firm, Hurl Callahan, and some of the other Medallion partners, really to ensure that we deliver for all of you in terms of investment performance, risk, and cost. We meet on a quarterly basis at a minimum to ensure that we review investment performance, understand what's going on in the markets, evaluate how things are being implemented, monitoring these portfolio managers to really ensure that your money's in good hands. And ultimately our role, as I mentioned before, is to report back to the board of the foundation to advise on whether anything should change, and whether anything should be improved or edited or adjusted. And then
Yes.
that is the role that we have as investment committee. And the next slide just talks a little bit about more specifically what the objectives of the foundation assets are. And that's really there's a lot of official words here, minimum financial benchmark, but we want to ensure the spending power of those dollars goes a very long way. And that means the portfolio results and returns have to, over time, compete with inflation, which will be a topic of conversation, I'm sure, later today, because inflation has reared its ugly head, as they say, and showed up here the last couple of years. So to ensure that the portfolio not only generates return to preserve that spending power, but also limit some of the volatility, if we can, in the market. So during periods like 2022, which we talked about last year, we won't talk about it this year. We already talked about that bad year. But that's part of investing, the ups and downs in markets, but ensuring that during those periods of volatility, that the portfolio is balanced and well managed. And ultimately, inflation, fees, and spending power are the ultimate benchmark that we want to try to outperform over the long run. So that's really the overall aim. And on the next slide, we're just going to talk a little bit about how we build and think a little bit. So when I talked about the policy, and we oversee the policy, the investment committee really thinks about what's the return expectations, what are the needs of the community, and in doing so, what does the portfolio need to do to grow? And we really think about the world in three general categories. So when I talk about asset classes, I'm talking about stocks, bonds, cash, and there's a number of different terms up here. But from a growth standpoint, that top blue bar there, that is really where we need to ensure that the portfolio outpaces that inflation rate. And so putting an allocation of 60 to 80% of the portfolio in growth assets or stocks is really the target range. And we monitor that to ensure that we're within that range on a regular basis. We talk about the endowed range and the quasi range. The quasi endowment is basically a shorter term objective, and therefore we don't have as much risk in the growth assets. We're taking a little bit more conservative approach. And you can see that total fixed income, which is the bottom line, that's really where you protect the portfolio, you generate income over time, and that is the area of the portfolio that can be used for those annual grants, if you will, meeting that $6 million on an annual basis. We go down into a little bit more detail here below hand, but if you look at the long-term policy targets, we look at these on a regular basis as an investment committee, ensuring that we're targeting the right mix of US stocks, international stocks, emerging markets, which includes India and China and Brazil, but also other things out there in the world of investments that are not traditional stocks and bonds. They'd fall into the category of commodities. We don't have any exposure at this point. Private equity, alternatives, really. Just to that, those components of the portfolio are there to complement the stocks and the bonds and to give us both return and also some risk management. And then finally, on the top left-hand side of this pie chart, investment grade fixed income and opportunistic fixed income are two areas where the managers, and we'll talk a little bit about this as I introduce Her O'Callaghan, they think about where the opportunities are in fixed income and where to allocate the portfolio specifically. On the right-hand side, we just go very big picture. If you look at all the assets of the endowed funds at the end of the year, 60% were in growth assets, 30% in fixed income, and 11% in those diversifier categories, which includes those alternatives. So really the next slide, I wanted to introduce to you really the way in which the portfolios are managed is by partnering with professional investment managers here in the area. So on the left-hand side, we're going to hear from Chris and Nick from Her O'Callaghan. The Community Foundation has partnered with Her O'Callaghan for many, many years to oversee and implement the portfolio on an ongoing basis. They are what's called an outsourced chief investment officer. So we're outsourcing their day-to-day responsibility of selecting investments and allocating within those portfolio asset classes to them. They manage 70% of the total aggregate assets. And that's really why they get the first opportunity to speak today. They are the partner that we work with the closest on your behalf. Some of the other names here, Truist, Merrill Lynch, Phoenixville Federal, S&T, who are represented here today, are what we call medallion investment partners. Those are selected by fund donors themselves to really ensure that they have the portfolio managed in the way they've always had. So that's part of the choice that you have as you come to the foundation. The investment committee oversees both Her O'Callaghan and the medallion investment partners, overseeing meaning due diligence, oversight, performance, risk, costs on your behalf. And with that, I will turn it over to Her O'Callaghan, to Chris Valerio and Nick Fazzi to talk a little bit about their role and how they're managing portfolios of late.
Great, thanks, Mark. Yeah, just as a quick introduction, I'm Chris Valerio. I've got my colleague Nick Fazzi with me today. Nick and I work full-time with the committee. And as Mark mentioned, it is a very deep, experienced, and knowledgeable committee. And I think that's what makes this partnership ultimately the best that it could be, because we've got transparency, we've got the structure set up correctly. So before Nick goes into looking back on 2023, and I think Mark characterized it well, where we all want to put 2022 in the past and just kind of anchor on 2023. A lot of good things happened. Let me just maybe explain a little bit about our firm. And those of you that have been on this call before or seen us in person, you know a lot about us already, but I think it's always good to set the tone, because getting the structure right and getting alignment correctly is half the battle in any good fiduciary environment. And when we think about the goals and objectives of where we collectively need to take this foundation, getting that alignment right is ultimately crucial. So what do we do? Mark touched on a little bit. We're an outsourced chief investment officer. And it wasn't something that we created. We took the ideas of the biggest and best endowments and foundations that were led by a chief investment officer. And these are typically $2, $3, $4 billion entities, and they have their own dedicated staff. And when the business was launched in '88, John Hurdle basically said, you know what, let's take this entire structure and bring it to clients that can't, basically afford to amortize their own in-house staff. And that's what we've been doing since 1988. We don't have any other lines of businesses, no mortgage, no investment banking, no debt structuring, just truly acting as a partner and extension of the staff at the Community Foundation. We've got 100 professionals, probably a quarter of them are dedicated full-time to the investment solution and how we think about, and that spans from, at the most illiquid level, the private equity team that's out seeing managers on site, to our long-only equity manager team, to our fixed income team. They're basically in the trenches, making sure that we've got the right managers in place for this foundation. We have over 200 client relationships, and they span both institutional clients and family clients. The business is about 50-50. So of our $18, $20 billion, that range, half of it's families, half of it's institutions. And a lot of them, quite honestly, are related. They know us from other institutions, or they're a family that brings us into their institutional board work. We are independently owned, which we think gives us an advantage that all of our capital and all of our resources can be deployed back into the firm to make sure that we've got the right solutions, and we're putting the best manager team and basically the best asset allocation structure that we can to drive ultimately results. And then, zero conflicts of interest. And those of you that have seen me before and heard me talk about this, I can't stress this enough, how this is so important. And what does it ultimately mean? It means that when we bring an idea to the committee, for example, we had probably about a year and a half due diligence with the committee on looking at private credit. What does private credit mean? Whether the committee would employ that or whether they would not employ that in the portfolio, we don't receive any benefits from that. It strictly is done on a zero conflicts of interest basis, so that we've got the right structure and alignment for the overall portfolio. So what's that structure look like, and how do we work with the committee? It's on the next slide. And this ultimately, we have enacted this over 24 years since we've been working with the foundation. It's the investment committee serves as the governing fiduciary, which basically means they are vetting not only us and the implementation and the performance that we're producing for the portfolio, but also various asset classes, various asset allocation structures. It's Nick's job and my job to lead that proactive advice, to bring ideas to the committee, and then working with the committee, we ultimately decide whether or not that structure makes sense. Then it's up to us as the manager. So if the committee sets the policy at 70% equities, we deploy that into active managers or passive managers on behalf of the foundation. And key piece of information here, we don't pick stocks. We hire what we consider the world's best money managers on behalf of the foundation, on behalf of the donor advised funds, to bring together the total portfolio. And then we oversee the managers, which is a deep due diligence process, both quantitatively and qualitatively. And then, at the end of the day, we've got to decide whether or not we retain the manager once we hire them, or we fire them and move on. So those are active decisions that our team will make. That then all gets reported back to the committee. So the committee is sitting in this very well-informed position that they can judge us and make decisions on how we're implementing the overall portfolio. So let me turn it over to Nick to talk about the good year that we had in the markets, and give a little color on where strategically we think these markets are going to go.
Yeah, good afternoon, everyone. So by way of background, my name is Nick Fazzi. I've been at the firm for 20 years or so. I work alongside Chris to deliver this proactive solution to the assets that you have entrusted to us. I'm also part of the Investment Policy Committee, the governing body here that makes decisions on your behalf in terms of asset allocation, who we allocate capital to in terms of how we're managing the portfolio. We've now had Mark and Chris both mention that they weren't going to mention 2022. in terms of performance. But what I can say about 2023 was we saw a near reversal in terms of equity market returns, and also a tremendous fourth quarter where we saw interest rates dramatically drift lower. Pretty decent results on the fixed income side as well, really led by U.S. equities in terms of equity returns. International developed stocks also had a very good 2023 as well. And the theme, if you're following your own personal portfolio, if you're reading the Wall Street Journal, if you're listening to CNBC, was this idea of narrow stock leadership, primarily in the U.S. in terms of a few names. Right here we have them labeled as the Magnificent Seven. Tesla may be facing some difficult performance here in 2024, but these names are really generating sort of abnormal returns for the market in 2023. You can see driving about 80% of the S&P 500 index returns. So any tilt away from the ownership of those names from a cap weighted construct, whether you believe in a small cap premia, whether you believe in a value premia, it was very difficult sort of to keep up with market-based benchmarks. The other thing that was happening in a pretty volatile manner is this continued theme of interest rate volatility, right? So, one of the things that we've been talking about, and I think we talked about the last time we had the forum, was just our belief that we didn't think that investors were being compensated for taking duration risk, meaning that we didn't want to own bonds with longer dated maturities, given the inversion of the yield curve, given that interest rates were so low for quite some time, a bunch of factors that were contributing to this. And we're starting to see that play out a little bit differently, right? Interest rates spiked dramatically. Our decision to have a more defensive posturing was rewarded. But we're starting to see signs of Fed's policy and central banking policy addressing inflation and inflation expectations for the future, having an effect on where the market perceives interest rates are going to land. And all I can say about that, but much like the stock market, it's very difficult to forecast these things with any certainty. I think it speaks to the governance structure that Chris mentioned, and through Mark's leadership, the tremendous amount of expertise that we have on the investment committee to really have a long-term plan, try to stay at best out of the business of making market forecast calls, right? I think last year is the perfect example, right? So if you made the decision to get more conservative in the portfolio off the backs of a very difficult and challenging environment in 2022, it could have had dramatic effects sort of in destroying long-term value for the portfolio, given the strength that we saw in 2023. So some of the themes that we had in play for your portfolio is we had a belief that we wanted to remain overweight U.S. stocks relative to international developed stocks. I think that was a decent place to be last year, despite challenges for active management within U.S. equities. So that was a positive from an allocation standpoint. And we had a slight sort of tilt to quality growth stocks, right? Obviously we wish we owned those 7 names in entirety, but to be tilted to both the U.S. and a quality growth factor, I think was beneficial for results last year. And then I talked about fixed income, right? Coming into 2022, we were much more conservatively positioned. Interest rates rose dramatically, continue to rise in 2023. And we took that as an opportunity to neutralize that positioning, meaning that we bought longer duration income instruments in the portfolio. And the thesis there was that we were being adequately compensated to take on interest rate risk. We thought that portion of the portfolio, should we go through an uncertain economic environment, would pay the benefit of acting as a diversifier, with the added benefit of having higher income, given that interest rates have reset across the board. Maybe flip forward to results across the board. I think I spoke to this, but across the board, strong results for risk assets, with U.S. equities really leading the charge. Okay, and you flip forward. Okay, I think this just speaks to the narrow stock leadership that I described in 2023. And if you look at this chart, the easiest way to think about that is if you just owned the Magnificent Seven, we have them footnoted at the bottom of the page here, right? Apple, Microsoft, Google, Amazon, NVIDIA. Facebook, also known as Meta, and Tesla, your results were 75% or so, right? And then if you excluded those names, you can see by the light blue bar, and you took the 493 that were existing in the portfolio, you had a much different experience, right? Up in the mid-teens. And so this is something that really drove market results in 2023. We were happy to participate. A good portion of your portfolio is allocated in a passive manner. And so US stocks, really led the way, led by the names on this slide here. Okay, and you flip forward. Okay, and then this just then speaks to style, right? We had a slight growth tilt. Even if you owned value and small cap, through November, these strategies were producing negative returns, right? So if you said, I want to own the companies that have the lowest price to earnings multiple, which is one expression of value that lens that you can take in the universe, you would have been negative returns through November, and then you can see the sharp snapback that we saw in December. But on balance, growth led the way in terms of equity returns, primarily in the US, and we captured a lot of that through our passive exposure. Okay, flip forward to the next slide. And then in terms of results, you see on the 1 year, a 16% return, we think is a very decent result, given how the market's unfolded. Benchmark at about just north of 17%. We also on the following page show you the results excluding sort of private illiquid marks or private equity. So sort of right on top of that benchmark, positive 17%, which we think is a very good outcome, particularly off the backs of 2022, particularly with the headwind for active management within the US. But we think that we navigated this market environment, obviously with the aid of the investment committee, sticking to our long-term plan, coming out of a very tumultuous 2022 timeframe, and then adding a little bit of value within fixed income. So on a 1 year basis, about 16%, 17% when you exclude the marks from the liquid assets, we think is a very favorable outcome in light of what occurred in the capital markets. Okay. And then in terms of asset allocation, I think Mark hit on this extremely well. The portfolio is broadly diversified. It has a predisposition to equity assets, right? So if we're trying to earn higher rates of return to maintain intergenerational sort of purchasing power, net of spend, net of the administration fee, we really have to have a portfolio that's oriented to equities. And so we have about 70% of the assets earmarked in this capacity. We have a 10% target to private equity as a way to earn excess returns over what the public markets are offering. And then we round that out with diversifying characteristics, both in fixed income, corporate opportunities, et cetera. I think the main themes that we've had on the portfolio for a number of different years is just an overweight to US stocks, which has benefited. We want to make sure that we're remaining diversified, not only by style, not only by active versus passive. So a healthy amount of your equity exposure is passively managed as a way to reduce cost and pass those fee savings along to you all to compound greater returns. But we also want to make sure that we're diversified by style as well, right? So, that's the one major thing that we've had on in the portfolio is that overweight to US stocks, which has benefited. And then I talked about the investment grade fixed income, which should serve as a ballast for the portfolio in uncertain economic times, right? So if you look back or rewind the clock 2 years or so, we certainly weren't getting the benefit of any type of real rates coming from fixed income. That has dramatically shifted. So now fixed income, we think, can play a diversifying role in the portfolio. We can allocate assets to it to provide that hedge against inflation, provide that diversification punch, but also give us some income as well. And so we neutralize that more defensive posturing given what we saw happen in 2023. Okay, and what you're looking at here is just the quasi portfolio, just managed to a much more conservative mandate, right? Where if you think about the endowment portfolio having 70% or so equity exposure, the quasi portfolio is designed to be much more conservatively oriented, give constituents a different option to invest the portfolio in a manner that reduces some of that inherent drawdown risk associated with having a higher allocation equities. And you can see the allocation here, right? 50% sort of long-term target to equities. as opposed to the 70% in the endowment portfolio. Similar themes, though, in terms of positioning, right? The overweight to U.S. still predominant in this portfolio as well.
Thank you, Nick and Chris. Good overview from Hurdle. And Mark, my gosh, we're like exactly on time, aren't we? How about we open it up for questions to our investment partners, including Hurdle Callahan, Phoenixville Federal, S&T, Merrill Lynch, Truist. We've got a bunch of folks here, and if I forgot somebody, it's your turn to speak up. Mark, you wanted to ask a couple questions, and if people have questions who are on the call, please. Between Mark and I, will figure it out.
Yeah, well, I'll get us started. And thanks, Karen, and thanks, Chris and Nick, for that review. We'll get to some sort of market-specific questions here in a moment, but I might start with you at Hurdle on the first question, because you manage both individual money for individuals as well as money for institutions. And one of the things that we at the Community Foundation just want to always highlight is what are the differences and what are the similarities when you think about managing portfolios for those two constituents. So I turn it over to you guys.
Yeah, Mark, I think that's a good way to think about things. And I think as Chris hit on very briefly, our business is segmented both by high net worth, family office, and the institutional side of the equation. I think as an institutional investor, you have that perpetuity type time horizon that should really serve as a sail, or the wind in your sail, with that long-term view to allow you to take on maybe some short-term volatility, be oriented maybe to a higher equity allocation if we think about this in terms of a perpetuity type investment. Now that's in contrast maybe to a personal side or a high net worth side where there's a bunch of different things in play, whether it's estate planning, taxability, obviously being the number one criteria. If you think about 2022 ending, and if you rebalance back into equities, you're probably squarely ahead of your overall equity target. So you're probably overweight risk relative to your long-term plan. So a consideration for a high net worth investor is you have to take into account, if it's in a taxable portfolio, the impact of what the tax effect would be to not only rebalance back to target, but then if you wanted to make a decision, right, to reorient your equity portfolio, you have to take into account the effects of that decision, right? Now, being a nonprofit, we don't have to really worry about that. So if we make a capital allocation decision on your behalf, the tax side of the equation it isn't predominantly driving sort of asset allocation decisions.
And quick follow-up on that, talking about allocation decisions and what you consider. In the endowed portfolio, there's a target allocation of 10% to private equity. And so how do you consider that in the context of that long-term objective, that long-term horizon associated with an institutional portfolio versus perhaps a personal account?
Yeah, certainly. So if we have this perpetuity type lens, and I always, every committee that I talk to, this portfolio is going to outlast me as your advisor, right? Hopefully at some point I'm going to retire, spend some time with my kids, my grandkids, if I'm fortunate enough to have them. Same with the committee, same with Karen, same with you all in the room, right? So this idea of this permanence of governance and this permanence of some sort of institution is really a strength, right? So if you can do without the need for sort of the immediacy of liquidity in your portfolio, right, and use that to your advantage, meaning that you're less concerned about short-term drawdowns. You can have a predisposition to equity assets. That's one way to think about it. The next step then is if you believe, and we're in this camp, that you can earn some sort of excess return over what the public markets are providing by allocating to private equity in a private manner, whether that's in venture capital, right, investing in companies before they go public at the very early stage, or whether it's taking control in privately held companies, reorienting them, making them more profitable, and then looking for some sort of exit strategy, and doing that with highly skilled managers. We think that's a way to earn sort of an incremental return of what you can get in the U.S. equity markets, the global equity markets. And so this portfolio has an allocation of roughly 10% to that. And much like the public markets, very difficult to time this as well. So we're in a market environment right now where private equity relative to 2 years ago, right? High flying growth during the COVID era, higher multiples, right? Stronger fundraising environment that has sort of flipped on its head somewhat, where deal flow has dried up. Companies sort of have a longer runway to profitability, less liquidity in terms of exits. But you know, if history serves as any guide, right, these are times that you don't want to skip sort of exposure here, and you want to maintain that diversification by vintage year. And so we think now is a great time to just sort of stay on course, maintain that exposure, and continue on the path to that allocation. And that's our belief.
Great. Yeah, I think that's helpful because
Hey, Mark, just to add a little bit to that too, not the private equity, but back to your original question. I think behavioral biases tend to differ between institutional investors and personal investors. And I've actually seen some personal investors think more like an institution, where they become really long-term oriented. They become very equity oriented and growth oriented. And I've actually seen some institutional investors go the other way. They get really conservative because they worry, and this is not the case at all at the foundation, is that they worry about their time on the committee versus the perpetual nature of the time horizon. So I think biases in general are a big deal, and everybody ought to think about that, you know, whenever you're investing assets.
Yeah, good point. Interesting perspective. Great, thank you very much. And I might turn it to this next question on inflation to some of the Medallion partners on the call, whether it be Kurt and Donna from Phoenixville, or maybe I'll start with you, not to put you on the spot, but we've heard Earl Callahan's view on inflation and where things might be going in 2024. Maybe you can just talk a little bit about your perspective on what's inflation and the impact it's having on the markets in your eyes.
Sure, thanks, Mark. We actually have Steve as one of our analysts is on, so I'm going to turn that over to him.
Yeah. Well, thanks. It is the question of the year, it seems like. I think it's probably a little early and premature to say we've won the war against inflation. I think the markets have effectively priced that in. If you've seen the futures market, where they're pricing in interest rate cuts for the Fed of 6 to 7 times this year. So, and you could obviously see it in what has happened in equity pricing as well. So the markets have seemed to take off here from October with the idea that inflation is behind us. I'm not so sure that that's the case. I'm sure you all experience it in your daily lives, whether you're at the grocery store or you're just, you know, buying anything for your home. It certainly is a big part of life. I think if you look back, what's really happened is interesting. You know, we've had 10 years of zero rates. You know, the Fed has, you know, pumped a lot of money into the economy over a decade. I think you may start to see some things just as a pendulum swinging back from that. So you're seeing things like protectionism, you know, in the wage market, in the labor market. You're certainly starting to see, I don't know if anyone, you know, is familiar with, you know, the UAW, you know, labor negotiations, but you're seeing a lot more of those things coming up. So it's a scenario where if you balance capital versus labor, you're seeing labor get, you know, kind of the upper hand of the markets. So these are some structural things that we're seeing that really, we believe, you know, I don't think inflation's behind us, but it certainly could put a floor to it and kind of prevent the Fed from kind of declaring victory of us being at like a 2% rate. So there could be like a new normal in play here, where you're seeing rates somewhere between 2, maybe the clearing, you know, neutral rate becomes 3, as Nick and Chris mentioned earlier. I mean, it's frankly a very good thing for savers and for foundations and, you know, for individuals, that you can have a ballast in your portfolio and get paid to actually hold money in the riskless part of your portfolio. So that's kind of how we're thinking about inflation in the long term.
Yeah, very helpful. And I might turn it quickly to John Stoddard at S&T if you want to make any additional comments on that, or what the opportunities you see out there as a result of what the Fed may or may not do.
I think the aspect of inflation that, you know, I've kind of looked at very closely is housing. And housing's been pretty stubborn in terms of the inflationary numbers that we've seen just in the last couple of days. You know, rents have increased 8% year over year. So I think that's a concern for us, because the housing component makes up a large portion of discretionary spending for consumers. And the US consumer makes up 2/3 of the economy. So that's something that, does concern us a little bit. If you look at the CPI numbers in the last week when the numbers came out, that it could keep inflation a little bit more stubborn over the next couple of months, because of that housing factor, the housing cost factor. And I think that could play also into, how much does the US consumer continue to spend in 24 and beyond because of the accelerating prices in terms of rent. So I think that's an aspect that we are looking at very closely as a component of CPI that's increased more than any other components within the CPI.
Yeah, it's an interesting point, right? If the economy is running too hot, Fed might be hand-tied in terms of what it can do, but then it could also lead to potentially a recession down the road if it eats into spending power, and that's really the key. So maybe, in that vein, I'm looking at some of the other partners here. I don't know if Diane from Truist wants to, provide a perspective here too, in terms of whether it's a soft landing here, but how are you thinking about the current environment and what risks do you see ahead?
Yeah, thank you. We're not sure that a soft landing is guaranteed. There are so many cross currents in the environment right now, in the economy and in the markets. You've got positives as well as negatives. And when we look back at history, has the Fed been able to execute a successful soft landing, which means there have been times where the Fed tightens policy, and we're certainly in that moment right now where they've increased the Fed funds rate by 525 basis points. The soft landing is when they can then go ahead and reduce that Fed funds rate, reduce short-term interest rates without a recession being triggered. And you might think, well, why would a recession be triggered as interest rates are coming down? It's usually the why. Why is the Fed cutting rates? So for the most part, when the Fed has tightened so much, a recession usually follows. There have been a few successful soft landings. Fed has raised rates, has lowered rates, and a recession didn't ensue. And that was in 85, 95. You could argue 2019 if you took the pandemic out of the equation. And but the time that they did not successfully execute a soft landing was 1967, although it seemed like they did. They raised rates, they lowered rates, and the problem was, and this is what Powell is focused on, Fed Chair Powell, in 1967, they lowered rates too soon. And so that soft landing was brief because inflation started to tick up and they had to then aggressively increase rates again. And so the recession came a few years later, 69 and 70. And with Powell having referenced that time frame, it leads us to the conclusion that until he sees much more evidence of inflation being consistently coming down, that they're not going to be in a hurry to lower rates as much as we think the Fed, the markets expect. And that's really, it's how nimble can this Fed be to execute this soft landing?
Yeah, that's great perspective, historical perspective too, because you can learn from history. Sometimes rhymes, as you know, but is it different this time? And I don't know, Jack, if you have any thoughts on sort of where there's might be some disconnect between what the market thinks is going to happen and what the Fed might do, and then ultimately what markets might react to that.
Yeah, I mean, in our view, I think we are still in an environment that's favorable for risk assets in general. We are aware of a number of risks, and I think that's one of your questions. The next question coming up here, we could talk about here. But in general, I think as we just heard, a lot depends on monetary policy here. And the Fed, for all their efforts, honestly, they're often late to the party, and they look at data that's often stale. John talked about the housing data. They often look backwards, and it's very stale housing data that they use in computing, owner's equivalent rent, which is a large component of the CPI index here. And it's one reason why they were late in raising rates 2021, and then perhaps went a little too far in 2023. We still expect rate cuts. We think they're needed. We expect only 3 to 4 this year, much less than what the market was originally pricing in. The fact is, I mean, there's been some unexpected strength in the economy in the last couple of months. We had a blowout non-farm payroll number back in January. CPI, PPI, as we said, came in a little hotter than expected, both the headline and the core numbers here. GDP has been revised upward for the US as well as globally here. So there's a lot of positive momentum, and we feel we're in an upcycle in our regime that's positive for most risk assets. That said, I think it's going to come down to Fed policy. Have they gone too far? Are they going to break something? I think we had a view of this last year when we saw Silicon Valley Bank and some of the other regional banks, go under as a result of the shift in Fed policy here. And there's still a great risk that they've gone too far, and we could see more of those types of defaults. In fact, not to get ahead with the questions here, but as far as the risks in the economy, I think market might actually be underpricing a reacceleration of inflation going forward here, just given the strength that we're seeing. The one caveat or the fly in the ointment might be the fact that retail sales the last month were weaker than expected, and the prior 2 months were revised downward. And of course, the consumer has always been the big engine of growth for the U.S. economy here. So that bears watching here. But the weight of the evidence for us suggests that the economy is in good footing. We're almost at full employment here. So there are risks to inflation, kind of reaccelerating here going forward here. And then we can talk about, the refinancing that's going on here. We have about $900 billion in commercial real estate that will mature this year. That's about 20% of the outstanding stock. How much of that's going to be refinanced and at what rate remains to be seen. But there's a risk again to a lot of regional banks, perhaps as many as 300 regional banks that could face some solvency stress there as a result of that. So bottom line is, I hate to sound equivocal and like an economist, on the one hand, on the other hand kind of thing, but the reality is a lot depends on monetary policy. I think we do need and we'll get 3 to 4 rate cuts this year, and hopefully that avoids a recession. So that's our base case here.
Yeah, that's helpful. And maybe the final question I have, given time, but the Fed, you mentioned Fed policy is going to be important and a driver, and it could break things. But I'm wondering if it could break the Magnificent Seven. Like, are they immune? It seems to be they're immune. If you look at the 493, they might be more impacted by Fed policy and interest rates. But this is a big question. This is a question for generally, but how do you sort of see the dominance of these names? The earnings do matter, and they're generating significant earnings.
Well, I'd take a quick shot at that and basically say that I don't know if they're in a bubble yet, but they're rapidly approaching bubble status. If you look at the valuation on the Magnificent Seven, it's 45 times earnings. If you look at on average historically, where stocks have gone, in past bubbles, the internet bubble, the Nifty 50, what have you, we're approaching that. And again, what's happened oftentimes when the Fed has raised rates, those bubbles have popped. So I do think they're at risk. I mean, they're great names. They're not going to go anywhere here. But it's certainly reasonable to expect for them to pull back or at the very least consolidate for a period of time.
Yeah, I think we're in the same camp there, in the sense that this disconnect between what the market implied forecast for rate cuts, sort of forward expectations for inflation, versus what's actually happening. When you see sort of a higher print in inflation, you saw dovish commentary in the fourth quarter, and then they walked it back on the 60-minute interview with Chairman Powell, right? This is a very data-dependent sort of environment. And so what the Fed does and how they communicate matters. I think if the market comes to the realization that this dovish scenario isn't going to unfold, then you have to square that with the earnings growth associated with these mega cap tech names, right? So, year over year earning growth has been tremendous, right, in these names, right? For the market at large, the S&P 500 forecast earnings going forward 10 to 12%, low double-digit type returns. If that doesn't happen for whatever reason, if we're starting to slide towards a harder landing, what have you, I think there is the risk of the higher multiple names sort of coming down from their loftier heights, right? So I think that's when you see all the active managers, some hold sort of a cap weight in the portfolio, but a lot of the active managers sort of tilting away from sort of the mega cap tech and the higher valuations that we're seeing.
Very good. And Karen, to keep us on clockwork time here, I'm going to turn it to you to see if there's
I
any
am.
further questions.
How about I do my little commercials for the Community Foundation for 30 seconds, and then if people have more questions or individual questions, you're welcome to stay. The Zoom call will not shut off, but I do see people are starting to leave because the 1 o'clock bell is sounding. So I want to thank you. I always learn more at the investment forums. It's good to see everybody on the same screen at this point, at least that. So thank you for turning out today for lunch to really take a look at the investments and what we're doing now and forever to really make safeguard your legacies. As we look, oh my gosh, we've got some terminology here. Isn't that great? And I'm not going to do the car commercial where we so there you go. A lot of you have zoomed in for our trainings for boards. Send your friends, send your colleagues, send people to our free board trainings every other Monday at lunchtime. And please zoom in for our community conversations. I think this next one is going to be on food security, and I think we're going to be able to bring in Farmer Jana to talk about what's going on at Pete's Produce West Town. No longer Pete's Produce, so all kinds of good things coming up with our community conversations. As I said before, we're a part of the Chester County 250 project, and I do see some heritage arts and culture groups on here from the Mill and Anselma and Historic Sugartown. To give a little shout out quickly for the Y for community groups. Zoom in to help us make history. Anybody who's interested in doing something to commemorate and celebrate in 2026, the time to start is now. So zoom in. And if you like desserts just a little, 16 desserts at Sweet Charity. So come one, come all, and help us find out the best tasting dessert. And oh my gosh, it's only 2 weeks away, not even that. So Sweet Charity, March 5th at Woodford Country Club. Thank you very much. And just save the date also if you're interested. Winnie Moran Sebastian's 2 years as chair are up, and Zeb Davenport will be taking over as the chair of the Community Foundation, and we'll celebrate that transition and reception on June 13th at Radley Run. So our transition reception is coming up, and it's all because of what you do now and forever. Thank you very much for helping us actively promote goodwill to fellow members of our human race and everything you do to grow philanthropy now and forever. I'm going to leave you all here, and if you have additional questions, stay on the Zoom call, and we will staff and some investment members will stick around. So thanks for everything you do. And Mr. Rigg, I see you there. Are you in California, Florida, Delaware? Where in the world is Mr. Riggs? No, you have to, yeah. Where are you?
Real quick, in California, but I want to give a shout out to Bob and Beth on this portal. It is absolutely tremendous. And for those folks that are administering these plans, the beauty of making the request directly over the internet as opposed to printing out and scanning and turning this back is wonderful. And secondly, it's got our history of giving for quite a few years in there. And I don't know about y'all, but my memory isn't always the best, and I don't want to forget some of these different funds. And it's the portal is the best thing since sliced bread, and I've only begun to look at it. So those of you that have any interest at all in making your life a little easier, get to one of these sessions. I think it's going to be great. Promise. I won't say anymore.
Thank you, Bob. And that's pretty good that you and Karen are looking at it and being able to make the grant awards through the portal. And yet we can still have fun chatting about just other things day to day, week to week. So thank you.